Now, in this video, let us look at some of the numbers and what should investors do. We'll try to explain you with the help of some charts and some figures that we have collaborated. So this is not the first time that the markets have gone down. Even in bull markets have gone down in the past, but they have also recovered at the end of it. So we have an interesting chart. So if you can have a look at your screens, this is not the first time that we have got this kind of a correction. If you remember, in the past 2001, the IT tech bubble, when it burst, it gave a negative return to the SIP investors. So SIPs at that time, 1st October 2001, were at minus 26.05%. This is SIP returns for 2 years, right? So 1st October 01, when the tech bubble happened, the returns are minus 26% for 2 years. When global financial crisis happened, the returns were about minus 41. When Eurozone debt crisis happened, it was minus 16.99. When the rupee depreciated in 13, it was minus 6.11. When China devaluated yuan, it was minus 15.06. So this is not the first correction that we have got. But what is interesting is, if you see the column after that, the next 3 years return. So 2 years were negative, but next 3 years the market delivered 54, 9, 33, 15, 8% kind of returns. This is CAGR returns that the markets delivered in the next 3 years. The total returns of an SIP for the total 5 years were 36, 10, 21, 17, 9. So if you see, these were big events. These were considered big events in the market. Market reacted also. It gave a very negative return. But in a 5-year period of an SIP, you got returns which are minimum of 10%, which are minimum of about 9%. So what we're trying to say over here is that these kind of events keep on happening in the market, but you should be patient with your investments and you should be systematic with your investments. You should remember the goals that you've done these investments for. You should remember the time horizon you've done these investments for, and then take a decision once your goal has been completed, not basis these market corrections which keep on happening. Another interesting data. So if you see your screen, we have 3 scenarios on the screen. Let's analyze scenario 1. Scenario 1 is what I call a panicky investor. This investor, after getting 2 years of negative return, stopped his SIP, and also he redeemed the entire amount that he had done in the 2 years. So if you see the data, and if you can also correspond to the events, 2001 was the tech bubble we are talking about, and 2016 is the China devaluing yuan we are talking about. So if you see, he would have invested 24,000, but if he would have panicked, stopped his SIPs, and taken out the SIPs, he would have got 18,000 in 2001, 15,000 in 8, 20,000 something in 12, in 13, 22,000, in 16, 20,000. So this scenario 1, where if you would have got a negative return and he would have redeemed and stopped his SIP, he would have definitely made a loss. Scenario 2, we keep on getting a lot of inquiries by our clients also that why should we continue SIP? Why not let's stop the SIPs right now, let's see what's happening in the market and then take a decision afterwards. So the scenario that I'm talking about is scenario 2, which is on your screen. The investor said, let's discontinue the SIP, but I'm not redeeming the amount. Let the amount be there, but I don't want to invest further in the market because it's going down. So so this data which you see on the screen, the values that you see is value as of 1st of August 2019. He has stopped the SIP. He's invested 24,000, 1,000 per month for 2 years. After that, he stopped the SIP. Now, if you see the values in 2001, that would be close to 7,89,000. 2008, it would be 96,000. 2012 would be 58,501. 13 would be 58,387, and 16 would be 34,993. Interesting. good values, he's made profits out of the basic investments that he has done, but has he accumulated enough for his goals is something to be pondered upon. Let's compare these figures to scenario 3. Scenario 3 is an investor who does not panic at all. He says, let my SIP continue. Even in panic times, let it continue. I'll not redeem my money because my goals have not been fulfilled as of now. So I don't need the money. Let the investment continue. Something that I do personally as well. So 2001, the investment amount, the first column that you see after the dates is the investment amount. The second column that you see is the value as of 1st August 2019. And the third column is the total number of years that he would have invested. So in 2001, the amount that he would have invested from 2001 till August 2019 would be about 2,37,000. But on 1st August 2019, this 2,37,000 would be equivalent to a whopping 21,49,630 rupees, as compared to scenario 2, in which he got 7,89,000, and scenario 1 he got 18,000. He's got a whopping 21,49,000 rupees. In scenario 3 itself, in 2008, his investment amount would have been 1,51,000. He would have got back, the current value would have been 3,50,000. 2012, 114, his current value would be 199. 13, 94, the invested value, the current value would be 151. And in 16, 64,000 is what he would have invested till August 19. His current value would be 79,750. Point we're trying to portray is, why stop your SIPs or your STPs when the markets are down? When the markets are down, when there is panic in the market, it is the best time to invest in the form of SIPs and STPs in the market. What you get is a downward average of the market. You're averaging out, but in a downward trajectory, and that is best for anybody's investments. So going forward, what we recommend is, in debt, we are again very bullish on credit risk funds, good credit risk funds. We have only 3 in our recommended list, and these 3 are the oldest funds, the biggest fund houses. So the debt funds we are very bullish upon. On the equity markets, we feel very strongly about small and mid caps. We feel in the coming 3 to 5 years, if you are continuing your investments in the form of SIPs and STPs, or even if you've invested in the form of SIPs and STPs in the past and now your SIPs and STPs have been completed, we feel the next 5 years should be very good for the small cap and mid cap segment. The large cap segment will always give you, will always make your path, your journey very pleasant, but to get the end results of making good returns from the markets, I think you should have substantial allocation in small and mid caps. So that's what we feel. Do let us know what you feel about the analysis, about the numbers, and about this videos in the comments below, and subscribe to our channel to get regular updates from now onwards. Thank you so much.